Right, let's have a look at our presentation and disclosure. Please remember, when you refer to your part B of your Psycho IFRS textbooks, there is templates. Therefore, please ensure that you flag this, highlight properly. Now, guys, it is important that you ensure that you understand how do we get to the amounts included in our statement of financial position and our profit and loss. Now, when you look at this, remember I have indicated to you in the revision recordings that our deferred tax will be included in our non-current assets or our non-current liabilities. You need to please remember we may only recognize an asset if there is sufficient future economic benefits to be able to use in future periods. And then in our current liabilities, we will have our income tax payable. Then our profit and loss statement at the bottom is our income tax expense. Right. Now, the standard indicates to us that we need to include a note on how did we get to this income tax expense amount and how did we get to our deferred tax asset or liability. Therefore, we will have to include two separate notes. Right, now, guys, this will appear to be busy, but please bear with me. I want to include quite a lot of details and I want to work with the different 3 pages together. Okay, so when we look at this, as I have mentioned, the standard indicates to us that we need to include our income tax expense note and our deferred tax note. Remember, this is a template, therefore you need to make this your own. You will identify that I have worked with a few colors for you to be able to identify similar principles. Okay, now, when we look at our income tax expense note, remember this is the amount in terms of our profit and loss statement. Therefore, the amount at the bottom should agree to our profit and loss statement. Our income tax expense note consists out of major components of our tax expense. The first component will be our current tax expense. Then we have our deferred tax expense and we have our foreign tax. Now, let's first have a look at our current tax expense. Our current tax expense consists out of our current period tax. And this is our calculation number 1, our current tax. Now, when you refer to our recordings, our previous recordings, you will remember that I have indicated to you when we need to calculate our current tax, we need to start with our profit before tax in terms of our profit and loss statement, our accounting rules. And we need to identify our reconciling items. Okay, before we look at this, you will identify I've included a line, prior year error, if any, and then the adjusted profit. Now, I want you to ensure that you please read the information carefully. It might be that they include errors in terms of IAS 8, which you still have to correct your profit before tax. But remember, this is only my template. Therefore, ensure that you please read the information. Now, we need to determine our profit before tax and then reconcile this to our taxable profit. Right, now how do we do this? We have our reconciling items. Remember, we might have expenses, which is allowed for accounting but not for tax. We might have expenses, which is not allowed for accounting but allowed for tax. We might have income, which is allowed for accounting but not for tax. And we might have income, which is not allowed for accounting, however allowed for tax. Remember your reconciling items. Then we will get to an amount, which is our taxable profit before, look at this, before our temporary differences. Remember, please just note, I'm not going to work through the reconciling items, the dividends, the fines, the donations, the depreciation on the office building, not deductible, and foreign revenue. There is an example. Okay, I don't want to waste time in this recording. Now, we have calculated our taxable profit before our temporary differences. Then we need to determine the movement in terms of our temporary difference. Remember, focus. We are busy calculating our current tax. Now, we need to refer to our deferred tax calculation, which is our calculation number 2. Right. If we look at the movement, what does this mean? you need to compare year 1 with year 2. Therefore, the movement, then this movement will be divided into 3 important things. Number 1, you look at the deferred tax calculation, we will have our movement in terms of our temporary difference. Sorry guys, that's not the number 1, that's the total movement. Movement in temporary difference, total movement. We will have the movement in terms of our profit and loss. We will have the movement in terms of our unused tax losses. And number 3, we will have a movement in terms of our OCI. Okay, now when we refer to the movement in terms of our profit and loss, it will be the temporary difference movement. Remember, if you look at your current tax calculation on the left side for me, please, we are looking at our taxable profit before temporary differences and then the movement in our temporary difference. When you look at our deferred tax calculation, we have columns at the top, our carrying amount, our tax base, and our temporary difference column. Look at this, temporary difference, and then our deferred tax column. Therefore, we are referring to the movement in terms of our temporary difference, and I'm going to call this, guys, let's call this A. This amount here should agree to the amount we include in our current tax. Therefore, the movement in our temporary difference. Look at this, temporary difference versus temporary difference. Okay. Then, when you look at our current tax calculation for me again, we now have our taxable profit before our unused tax loss. Now, important, before the unused tax loss. We will then include our unused capital losses, tax losses, or our unused normal tax loss. Remember that you will get this from your deferred tax calculation. Okay, again guys, the movement in your unused tax loss. Look at this, unused tax losses, capital, and so forth. Capital losses. Therefore, you will get this from your temporary difference column. Okay, now you have determined your taxable profit amount times this by the tax rate, and this will then be your current tax. Now guys, let's call this B. Okay, this will be our current tax, and that amount should equal to the amount that we include in our note B, our current period tax. Right, remember we are still busy with our current tax expense. Included in our current tax expense is our current tax for the period calculated calculation 1, and there might be under or over provisions from our prior. Therefore, you need to identify this from general ledgers or the information in the scenario which they provide to you, because we need to determine the total amount of current tax for the current year that should be paid over. Right, now let's have a look at our second component of our income tax expense note, and this will be our deferred tax expense. Okay, now the deferred tax expense consists out of 4 important sections. Number 1, movement in our temporary difference. Number 2, our unused tax losses created. Now, what does this mean, create? We create this loss to be used in the future year. Therefore, we create a loss this year that we want to use in future. Number 3, unused tax loss utilized. We use this. And number 4, if there is a change in tax rate. Okay. Now, when we look at our movement in our temporary differences, now look at this. I've included here that this is the 28% amount. Therefore, the amount that you need to include here in your income tax expense note, if you refer to your deferred tax calculation, This will be the movement in your profit and loss. Okay, guys, I just want to change this, and I'm going to include this as blue. It's this amount in your deferred tax column. Let's call this reference C. Look at this. Movement in your profit and loss. The blue, the C, should be included in your income tax expense note, C. Okay, so what I want to indicate to you here, and please listen to me carefully. If you look at this, look at your current tax calculation for me first. And I'm going to make use of pink. Look at the movement in your deferred tax. Do you agree with me that we include the movement in our deferred tax? The temporary difference, okay? Then at the bottom, we times this by 28%, okay? Then, when you look at our income tax expense note for me, reference C, we include the movement in our temporary difference times 28%. Therefore, technically speaking, that temporary difference times 28% is included in B and C, and this will net out to 0, the debits and the credits. Okay, guys, there is a separate recording in terms of the debits and the credits and an example. Therefore, technically speaking, guys, we're not actually paying or receiving anything in terms of the deferred tax. The deferred tax exists due to a future tax, which is a timing difference in our accounting and our tax rules. We include the temporary difference in our current tax. We times this then by 28%. It comes through via B into our current period, and we include this in our deferred tax, the 28%. Therefore, the net effect will then be 0. Remember, we are still busy with the deferred tax expense, the second component in terms of our tax expense. We have now looked at our movement in our temporary difference. Then, second, there is our unused tax loss created that we need to include. We have our unused tax loss utilized that we need to include. Remember, also from your deferred tax calculation. I'm sure you understand the principle by now. And then number 4, there is our change in tax rate, right? Now, if there's a change in tax rate, guys, this will come through in terms of our deferred tax calculation as well. We will have to include in our calculation, let's say, for example, in year 1, there was a change in our tax rate, and then this amount in here, guys, should agree to our income tax expense note. Okay. Just important to note, and I'm going to get to this just now, if there's a change in tax rate, IAS 12 requires additional disclosure, and this is in paragraph 81 in terms of changes in tax rates. Okay. Then, when you look at our income tax expense note, number 3, our foreign tax. Now look at this. This is your total tax amount paid. This is the amount that they have paid, guys. Important, please, please, please remember the amount paid. Okay. Therefore, when you look at our current tax calculation, we have a line item, our foreign revenue. Now, we take into account the foreign revenue that we need to take out. Why do we take this out? Think about this again. For accounting purposes, we've included this. Therefore, we need to take this out. But for tax purposes, we include the tax amount in our income tax expense note. Therefore, we already include the tax amount. Therefore, we can't include this revenue when we calculate our total South African taxable profit. Okay. Guys, please identify that it is the revenue that you need to take out and that you need to include the tax amount paid. Right. Now, we are able to include our total income tax for the year, which should agree to our profit and loss statement. Right. Now, guys, a lot of students don't understand, why do we have a tax rate reconciliation? What is a tax rate reconciliation? Why do we have this? Okay, so when you look at a tax rate reconciliation, it starts off with our accounting profit. Remember, in terms of our profit and loss, our accounting rules. Exactly, guys, when you look at our current tax, this is going to get a bit confusing. I should have used another color here. Okay, it's our profit before tax, our accounting profit, right? Then we times this by the tax rate, which is the 28%. And this will then be the accounting profit times 28%. Now, what do we do here? We compare this amount here to the total income tax expense at the bottom. Remember, the total income tax expense, which we have determined in terms of our income tax expense note. Therefore, these two amounts agree. I'm pretty sure you understand this. Okay. Now, we need to identify, why is there a difference? What is the different items in terms of the different rules for accounting and tax? What happens here? Now, you're pretty straightforward line items, which I have included here in green. If you look at our recon, I've included the dividends not taxable. Therefore, again, guys, if you think about this, it is included in our accounting rules, but not in our tax. Therefore, we had to take it out. Same with your current tax. Guys, look at the green, dividends not taxable. Next, fines, donations paid, depreciation on the office buildings, right? You with me on this? Pretty straightforward. What is included at the top, which is not at the bottom? Compare apples with apples. Okay. Therefore, when you now look at our income tax expense note, I'm going to work through this from the top. Okay. We have looked at our current period, the B amount. Okay. We have identified, except for our foreign revenue. We will get back to this. Then the second line item, our under or over provisions. If you think about this, under or over provisions, we have now included the amount of our under over provisions in the total income tax for the year, guys. The total income tax for the year. But that under over provision is not included in the accounting profit times 28%. It's not included in the pink amount. Therefore, this will be a reconciling item. We need to include our under or over provision for the current year in our reconciling item, because it's not included, guys, in the pink amount. It is included at the top, but not at the bottom. Next, our deferred tax expense, the movement in our temporary difference. Remember, we have identified that it nets out. Our next line item, unused tax loss created. Now, think about this one. If we create an unused tax loss, this will be a deferred tax asset, right? You with me on this one? And this will be due to the fact that we had a loss, an accounting loss, most probably. Therefore, if that was a loss times 28%, our amount here will be the loss. And technically speaking, then this loss is included, guys, in our amount at the bottom. Therefore, this will not be a reconciling item. Then, if there's any unused tax losses utilized, which we have used, if we think about this, we use a prior loss created. If we use that loss created in the prior, this will be included in our current tax calculation that we have used the loss to be able to calculate our current tax. Therefore, guys, will this be a reconciling item? The net effect will be 0 because we will deduct it in our current tax and we will add it in our income tax expense note. Therefore, the net effect will be 0. Right. Okay, then important, when you look at my tax rate reconciliation, I've added unused tax loss not recognized or an unused tax loss utilized that was not previously recognized. Therefore, just watch out for these two because they might be included in a scenario. Okay, then at the top, we have our change in our tax rate. Therefore, guys, it is included at the top, but not at the bottom. Therefore, we need to include our change in tax rate. Then, foreign tax. We have our foreign tax. When you look at this again, guys, we have the tax amount included at the top. Okay? But at the bottom, the effect of the different tax rate on our foreign income. Why? Because we include this at 28% in our accounting profit. But at the top, we've included the total tax paid. Therefore, you need to compare the amount in terms of your 28%. Compare this with the actual amount paid, and that will be your reconciling item. Okay, guys? Then important, if there is a change in your tax rate, there is additional disclosure in terms of IAS 12 that you need to include. Okay, so let's have a look at our deferred tax note. Guys, this is pretty straightforward. In our deferred tax note, we need to list all of the amounts as per our deferred tax calculation. Therefore, we need to include an analysis of our temporary differences. Out of what does our temporary differences consist? For property, plant and equipment, it might be accelerated deductions for tax, revaluation. There might be a provision, income received in advance, prepayment expense, unused tax loss for normal tax, and then this might then be your deferred tax asset or liability. Remember, important that this amount here in terms of your note should agree with your deferred tax calculation, the total of the deferred tax for the year. Therefore, for example, if we look at year 2, we've included our assets and our liabilities, everything, and then at the bottom we will have our deferred tax, the total, the green. And this should agree to our note in terms of our statement of financial position.